Let's talk about a safety net for the entire global banking system. A safety net potentially worth over 56 times trillion dollars. Yeah, that's a staggering number. In this explainer, we're going to break down how this massive, privately held pile of assets is being proposed as a way to completely rewrite the rules of bank safety. So let's dive right in.
So here's the puzzle we're trying to solve, and it's a real head-scratcher for any bank. How do you build up your financial cushion to protect against a crisis, but, and this is the key part, do it without selling off new pieces of the company and watering down the value for your existing shareholders? It's a challenge that's been around for, well, forever.
Okay, so before we get to the solution, we really need to get our heads around the problem. And it all boils down to one simple concept: bank capital. Just think of it as a bank's own money, its financial cushion, its first line of defense when things start to go sideways.
So what is bank capital exactly? Well, it's not the money you or I deposit. It's the bank's own funds, money that comes from selling shares to investors and from profits they've saved up over the years. This capital has one main job: to absorb unexpected losses, making sure the bank can stay in business and, most importantly, that our deposits stay safe.
Now you might be wondering, how big does this financial cushion actually need to be? Well, that's not just left up to the banks to decide. There's a global rule book that pretty much every major bank has to play by. It's called Basel III, and it sets the gold standard for keeping the whole system from falling over.
Let's peek inside this rulebook, shall we? You see, Basel III isn't just about having one big pile of cash. It's much smarter than that. It's all about building a financial shield with multiple layers, where each layer is designed to take a hit at different stages of a crisis.
And this shield has three really distinct layers. Right at the heart of it, you've got CET1. This is the best of the best, the highest quality capital. The next layer out is AT1, which kicks in to absorb losses while the bank is still up and running. And that final layer, Tier 2, is really the last line of defense to protect depositors if the bank is, actually failing. Every single layer is absolutely crucial.
So what's the magic number? Well, under the Basel III rules, a bank's total capital, all those layers we just talked about combined, has to be at least 8% of its risk-weighted assets. The second a bank dips below that 8% line, believe me, alarm bells start ringing for regulators, and that bank needs to find more capital and fast. And this is where things get really interesting. This is where a new and potentially game-changing player enters the scene. We're talking about a private entity known as the NVC Fund Holding Trust, and they are proposing a totally different way to solve this whole capital problem.
And the scale we're talking about here is, well, it's almost hard to comprehend. The source material claims the NVC fund is backed by hard assets that have been independently valued at over $56.7 trillion. I mean, just to put that into perspective, that is bigger than the entire yearly economic output of the United States, China, and the Eurozone combined.
So what are these assets? Well, according to the source, they are physical, sovereign-grade assets, not just stocks and bonds. And here's the crucial part: their value isn't tied to the financial markets. That means when the stock market takes a nosedive, these assets don't necessarily follow. They're fully owned, and they aren't being used as collateral anywhere else, which means they are clean and ready to go. Okay, so you have this incredible pool of valuable assets, but how do you actually turn that into official regulator-approved capital for a bank? The process they've come up with is actually pretty clever. Here's the key. The NVC Fund's assets are used as the backing for new financial instruments. Think of things like special bonds or notes. These instruments are custom-built to meet the very strict criteria for what counts as AT1 and Tier 2 capital under those Basel III rules. A bank can then simply acquire these instruments and add them to their balance sheet.
So, let's imagine a bank in a tough spot. You can see here its total capital has dipped just below that critical 8% minimum. The regulators are calling and the bank is under huge pressure. It's a really bad place to be.
And then here's the aftershot. The bank adds one of these NVC-backed capital instruments to its books. And just like that, instantly, its capital ratio shoots way up, comfortably above that 8% minimum. Problem solved. The bank is back on solid footing.
Now, when you compare this to the old way of doing things, the difference is just night and day. Traditionally, raising capital means selling new stock, which dilutes the ownership for everyone who already has a stake. It's slow, and it completely depends on whether the market feels like buying. But the NVC method, it's non-dilutive. It uses pre-made instruments that are backed by that enormous asset base, making the whole thing faster and totally independent of market mood swings.
But listen, this isn't just some clever accounting trick for one or two banks. The whole idea here is that if you implement this on a massive scale, it could have a huge strategic impact on the entire financial system and on the economy as a whole.
So what's the payoff? Well, for starters, banks can immediately get on the right side of global regulations. And a better capitalized bank isn't just safer, it can actually lend more money, which is the fuel for economic growth. A stronger banking system can even boost a whole country's credit rating. And there's even a cool tech angle to it, using a digital token on a blockchain for instant verified settlement.
So this all leaves us with a pretty fascinating question to chew on. For decades, we've thought of bank capital as something that comes from profits and the stock market. But this model, this points to a completely different path, one where vast, real-world physical assets could be used to anchor our entire financial system. Could this be the future of financial stability? That's a multi-trillion-dollar question that I'm sure a lot of people are going to be thinking about.